Welcome back to the deep dive. We crack open complex financial topics, give you the core insights. Today, we are really getting into your sources on alternative investments.
Right.
We're talking about how these, unique strategies work, how to measure them, and crucially, if they actually fit your goals.
Yeah. Think of it as a shortcut.
Exactly. A shortcut into a pretty fascinating corner of investing.
Absolutely. We'll pull back the curtain a bit on how managers try to profit.
And the risks, right? The specific risks involved.
Oh, yeah. Definitely the risks. And, the key questions you really need to ask before jumping in.
Yeah, I did.
It's about getting past the jargon, really understanding the mechanics.
Okay, so let's unpack that. The big question is, how do these strategies actually generate returns?
Well, it seems to boil down to three main kinds of approaches based on the sources.
Which are?
Relative value, event-driven, and directional.
Right. And the key difference is how much they kind of ride the market waves.
Exactly. That's a great way to put it. Their exposure to market movements.
So relative value first.
Yeah.
Like equity market neutral.
Yeah, those try to exploit really small pricing differences, things that maybe shouldn't be there.
With low market exposure, ideally.
Right. They try to neutralize the market effect. One source had that example, two bank stocks.
Ah, yes, I saw that. Going long one, short the other.
And it generated, what was it? A 19.08% annualized return in that specific case. Pretty impressive.
So it's purely about the relative difference, not whether banks overall are going up or down.
Precisely.
Okay, that makes sense. But then you have these big corporate events like mergers.
Right. Acquisitions, spin-offs.
That must create opportunities too. That's event-driven.
That's the one. Merger arbitrage is a classic example. You're betting on a specific event happening.
Like a deal closing. The source example showed a stock trading 4% below the offer price.
Yeah, and if the deal closes, that could potentially lead to over an 8% annualized return.
But the risk is the deal doesn't close.
That's the main one, yes.
Right.
Deal risk. It's tied to a specific catalyst, not the S&P 500.
Okay, got it. So relative value avoids the market. Event-driven focuses on specific events. What about directional? They lean into market moves.
They do, but with a twist. Think long-short equity.
So picking winners and losers.
Exactly. Trying to capture alpha on both sides. Going long stocks they think will outperform.
And shorting the ones they expect to underperform.
Right. Whether the market's generally rising or falling. The material showed one example hitting 23.75% annualized.
Wow. Okay, so these are definitely not your standard buy and hold strategies.
Far from it.
So for you listening, how do you actually access these? Often through alternative mutual funds, right? But there's a catch.
A big one.
Liquidity.
Meaning how easily you can buy or sell.
Precisely.
Yeah.
Regulations and the need for daily access mean only the most liquid strategies work in these mutual fund formats, like managed futures, equity market neutral. They trade things like futures or liquid stocks.
But not things like private equity or, say, direct real estate. Generally, no. Those are too illiquid. You can't easily sell a piece of a private company or a building tomorrow if needed.
Makes sense. Okay, moving beyond strategy types. How do we measure performance? You mentioned standard deviation isn't always the best tool here.
That's spot on, because the returns often aren't normally distributed. They don't always follow that neat bell curve.
So averages can be misleading.
Very. You need to look at things like does it skew towards big wins or big losses? And kurtosis, are there fat tails, meaning more extreme outcomes than you'd expect?
Fat tails, like unexpected crashes or spikes.
Exactly. And even more practically, you want to look at drawdowns.
The peak to trough drops in value.
Yes. And critically, the time to recovery. How long did it take to get back to the previous high point after a fall?
That tells you a lot about resilience.
It tells you about the real-world pain and recovery, which standard deviation often masks.
So if standard deviation isn't the whole picture, what's the biggest surprise for investors evaluating these, and what due diligence questions are essential?
I think the surprise is often how reliant you are on the manager's specific skill, their edge. It's less about the asset class sometimes.
And the questions.
Oh, you need to dig deep. The manager's background, their actual process, their risk controls. How do they manage downside?
You mentioned risk frameworks and leverage.
Crucial. Do they have clear rules to cut losses?
Yeah.
How much borrowed money, leverage are they using? Because leverage cuts both ways, amplifies gains and losses.
So it's like inspecting a house before you buy.
Exactly that. You wouldn't skip the inspection. You need to understand the plumbing and the foundation of the strategy.
Right. So wrapping this up, what does this all mean for you? Are these strategies for everyone?
Definitely not. Suitability is key.
Who are they generally best suited for?
Usually, investors who understand diversification well get the concept of leverage.
And maybe aren't just chasing the highest possible number.
Right. Maybe focused on absolute returns, positive returns, regardless of market direction or specific risk reduction.
And they probably need a medium-term horizon.
Typically, yes. And if using liquid alts, they value that short to medium-term liquidity. It's about smart portfolio construction, not just a gamble.
So ultimately, understanding these alternatives lets you be more active, more informed in aligning your money with your goals. It prompts that question. Are you thinking deeply enough about where your money is working? And have you explored all the potential tools?